Live. Hello.
Hello, everybody.
Hello. So it's the Monday after spring break. All the kids have gone back to school
Ish.
and I
I'm like,
and I can
yes.
work. And I can actually work. So it's nice. Usually when the kids are here, my little one will stand in my chair behind me and chokehold me the entire time I'm trying to work.
He
So
just loves
it's
you so
fun.
much.
He does. He loves me so much and it's fun. So yeah. So did you do anything crazy for spring break?
Okay, so Roger and I have been married for 16 years as of the end of February, and 4 anniversaries. We got married on late day, and so
That's right. That's right.
we went to San Antonio. I had never been, and so we went to San Antonio, which was a ton of fun.
Good. I like San Antonio. Oh, I lived there
Wait,
during
you
my
lived there?
yes. Remember we were empty nesters. I've told you this. We were empty
Okay.
nesters. I had a midlife crisis and told my husband,
Oh,
"Let's move to
yes.
San Antonio." So we moved to San Antonio and we were there for like 5.5 years, and it was awful the entire time. So
Did you
we
like to
couldn't
visit?
wait. Well, at first it was okay, but then it was. We're just not city people. We're not city people.
Mm-mm.
Traffic, busyness, we don't like that. And so we were desperate to get back to our little bitty small Texas town, and we finally did. So,
Okay, funny story. When I graduated from tech, I had every intention. So, we're in Lubbock. My family, my husband's family is from here. My family is from across the state. And so we wanted to settle in Dallas to kind of be in the halfway
in
between
the
point.
middle.
Okay. Well, I did an internship in Dallas with one of the big four companies, got made an offer, but on my very, very first day there, I got in a wreck and I freaked out and was just like, yeah, I can never drive in this town. And so that's how we decided to stay in Lubbock, because somebody hit me and I was too scared to teach my kids to drive there. My entire time I rode public transit.
Wow. Well, there's something to be said for going back home. So
Yes, I love small Texas.
I do too. I love small towns, and that's why we do a small business show, because we love small towns and they're mostly small businesses. And so here we are, right?
Here we are. They're the backbone
Well,
of everything that we
they
believe.
are. They are the backbone of our nation. So, with that, let's play the intro and let's bring these guys on so we can talk and give some good information. You want to?
Yes.
Okay, here we go. Hello, and we're back. Welcome to episode 11 of the Down Home Texas Small Business Show. I am Tammy Fisher, an enrolled agent,
And I'm Amanda Adams, a CPA.
and we're both in Texas. And our guests today are not, but that's okay because they still work with self employed people and small business owners. And today we're going to get into the subject of retirement savings and investments and how that works for tax deductions and what's best for you, what options you have, and all of those good things. So, without further ado, let's bring them on.
Good
We have,
morning, Megan. Sorry,
we
Megan
have,
shouted us out. And so, hi, Goose.
good.
Hi,
Here he
Michael.
made it. All right.
Hello.
Technical
Hey guys.
difficulties earlier, but he made it. Good
I
to see you
yeah.
guys. All
You
right.
gotta love technology.
Sometimes.
Sometimes,
Never.
sometimes we
Never.
do. Sometimes we. So, let's. I want to give you guys a chance to introduce yourselves. Tell us a little bit about what you do, and then we'll go from there. So, Goose, you can go first.
All right. Well, first, I appreciate you having me on. I met Amanda, I guess, about a month or two ago on a little coffee chat, and we connected mostly because I spent 12 years in paper manufacturing, spent both of those in a small town, Stevenson, Alabama, about 2,500 people, and then Selma, Alabama, about 40,000 people. So very much understand and love the small town feel and the connection that you have and get from a small town. I had my daughter and decided that manufacturing really wasn't the life I wanted to live in order to be the dad I wanted to be. But always have thought that there's an opportunity within that space to help drive better financial decisions, more knowledge around financial decisions, so that ultimately they don't have to spend their whole life walking 12 miles a day on concrete. And so that's really my passion and why I got into financial advising, was to really show them and give them a better path to that financial freedom we always talk about.
That's cool. I heard that Southern accent coming through.
It's from Alabama, it's here.
It's there, right? Okay, Michael, tell us about you.
Yeah, thanks for having me as well. I'm excited to be here, excited to talk about retirement accounts and how that can apply to business owners. And so I'm a CFP, Certified Financial Planner, and I have my own independent wealth management practice here in Colorado. So I'm on the west part of the country. I consider it like not the West Coast, but definitely the west part of the U.S. My wife says I'm from the Midwest, but I try to tell her, no, Colorado's not Midwest. That's like Minnesota and Illinois. But I'm out here in Colorado. And before I had my own practice, I was at a big brokerage firm. We call them wirehouses in our world. And I was an employee there doing financial planning and investment management, but ultimately wanted to go out on my own, so that I could just serve my clients in the best way possible, but also to have just more autonomy and freedom to be able to run my practice how I wanted. And what I didn't really understand at first when I did that is I was going out to be a business owner myself. And so learned a lot about being a business owner, and it's just allowed me to help other business owners with their situation. And, to kind of piggyback off what Goose said, it is about helping people become financially independent, but I always like to frame it in a way where I like to help people get in a position with their money and their wealth to be able to bless their families and bless others. And so love doing that. And I've been in this industry for almost 13 years this year. So, yeah.
Cool. So one of the things that I've noticed about working with small business people, and I think, Michael, you and I have talked about this a little bit, is their tendency to think right here in front of them and not look at things long term. How do you guys talk to people and get them to start thinking in the right direction?
Mm-hmm.
I mean, you know where I'm getting at?
Yeah. Goose, if you don't mind, I'll just kind of jump on that question, and then, you can jump in and give your thoughts. But I think that probably the easiest way for me with a business owner is talking about taxes, right? They're very, mindful about taxes, most of them at least. And so if you can, no, well, maybe not mindful is the right word, but they want to save on taxes at least, and they want to pay less.
They do that.
Maybe not. Yeah, mindful is
pay less.
a bad word. As you two ladies know, they probably come to you last minute and say, "Oh my gosh, like I owe this in taxes, or what can I do for this or that?" And you're probably thinking, "Well, you probably should have thought about this sooner." But maybe they're not all mindful, but they realize the importance of trying to reduce their tax liability and trying to pay less in taxes. And I try to start there with a lot of them because with retirement account contributions, it's a quick, easy way for them to get a deduction. And I always try to plant the seed when we're talking about that. Not only are you getting a tax deduction right now, but to your point, Tammy, let's look into the future. And this is going to be a way that you can build a bucket of assets for yourself where when you exit your business, you're not going to be like, well, what do I do now? How do I support my lifestyle or, generate some income? It's going to be a way to help with that transition out of the business at some point.
So Tammy, I don't think it's just small business owners. I think that we as a society like instant gratification and we like to get something today, right? So it's not just something that they struggle with.
I feel called out.
I know. I'm like, oh gosh, you're doing me hives.
All right, already getting in trouble. It's pretty mighty early in the show to get in trouble. But I really like to set out short-term goals and then slowly work later, right? And then sometimes just simply asking the question, how do you plan to get there? And that starts really getting them to think, right? I don't really know how I'm supposed to get there. And that helps them just reframe this long-term goal into shorter buckets. That's really worked, and to Michael's point, it's not how much you make, it's how much you get to keep. And I think that always resonates with people. You can make a lot of money, but if you don't have the right strategies in place, you're going to give a lot of that money up, especially as a small business owner. So just framing it that way kind of resonates too from my end.
Yeah. And this thought just came, into my mind with business owners too. You can try and, tell them, hey, if we don't do a retirement account contribution for this year, this tax year, this is what you're going to pay in taxes. If we do make this contribution, let's say, hey, if you put 20 grand into this SEP IRA, you're going to pay less in taxes. And so would you rather take 20 grand and put it in a bucket for you, keep it on your side of the balance sheet, pay less in taxes, or do you just want to pay more in taxes? So trying to get them to understand, yeah, this is long-term money. It's not instant gratification, to Goose's point, but there's some instant benefits now that you can realize. And again, have that bucket of money down the road for you.
Okay, so we've had a previous guest on, Michaeli Morrow Esdell, and she is a financial therapist. And she's made some comments, if you have not followed her on LinkedIn, you should, about really some of the bad habits that we come into money with or we learn in our childhood. Are you guys having to kind of help your clients through those things to overcome like bad money habits and obstacles to get them to understand how important it is?
So, yeah, I mean, I think that a lot of our job is being that coach, right? It's understanding what they went through in the past, because you are who you are because of the past. That doesn't mean you can't change. And that doesn't mean you can't be a different you in the future. But until you can truly come to grips with what's happened in the past and the reason you do with what you do, you're never going to move forward. And I'm going to shout out a book here because I think it's a great book for anybody that's struggling with this. But everybody should read The Psychology of Money. It really shapes, it puts things into perspective. And it really put things in perspective for me about what other people are going through, what my clients are going through, so that there is no judgment. And you don't need to judge yourself, and we don't need to judge our clients because we all have a different story that we've lived.
Mm-hmm. Yeah, I would say, on that, there's definitely a lot that goes on with someone's behavior when it comes to money. And this is kind of a term that's going around like behavioral finance now. There is a lot of good stuff in that idea that, people have their kind of their relationship with money, like Goose was saying, based on their past or how they grew up, or maybe what their parents kind of instilled in them with money. And so I wouldn't necessarily say, or at least I don't look at myself as like a coach necessarily. But I will give you obviously some advice, and kind of point out some areas where, hey, you may want to just look at this differently, or this is how you should maybe approach this, and think about it differently. It's hard for me to come and tell someone, and I don't really get into this telling them how to spend their money, because that can be very personal, and people just, there's some things they want to spend their money on. They don't want to mess with that, but trying to maybe slowly advise them on how to look at certain money situations differently, and show them, if you keep going down this road, here's an outcome for you. But if you make this change, here's what that outcome will look and how it's going to benefit you. If that makes sense.
It does.
I think some of it comes down to alignment, right? I mean, you have your spending habits. Do they align with what your goals are? Do they align with what your values are? And so often they don't align. I think Michael probably can name tons. I certainly can, about where you actually dig into it and they don't align with what you say you care about.
Right.
Interesting.
So let's get into the meat of our subject here for today. And either one of you can field this. Tell us what type of retirement accounts are available to someone who's a small business owner or who's self-employed, and how they work. What works, I guess, what works better for one than the other?
Not an easy question. Whoever wants to field that.
It's not an easy question, but just let's start with telling us what's available for those who don't know.
Sure. You take it. Yeah. You want to take it, Michael?
Sure. I can just kind of get us started. I mean, there's so many scenarios, but there's 401ks. We're all familiar with those. Both, like a regular one or a solo 401k. You may have seen that floating around on LinkedIn or Twitter or X, whatever it is now, a lot. There's the SEP IRA. There's simple IRAs. There's defined benefit plans, which are still around. Like that's a pension basically. So the 401k is a defined contribution plan where whatever you contribute is defined. There's a set amount you can define. And then there's the defined benefit plan, which is going to be like your pension. And believe it or not, yeah, those are still around. And those are an option for certain business owners, depending on their revenue level and how much they're able to save consistently, because there's obviously IRS rules, go figure, with staying compliant within those. And then within defined benefit plans, there's another plan that is still around. I don't see it a whole lot, but money purchase pension plans, cash balance plans. So most people are familiar with those defined contribution plans, like the 401k, 403b. That's for nonprofits.
Okay.
But it's somewhat similar to the 401k. There's some nuances that are a little different, but those are kind of the ones that jump out, to me that I've used and helped business owners with, recently.
And in terms,
you want to add anything to that?
Yeah, I'll add to it, because one of the questions you asked was which one's the best, and we're not going to sit here and tell you which one's the best, because it's different for each person, right? It's different. It depends, and all of them have benefits. But
that's our favorite answer, by the way.
Absolutely. They all have benefits, but they all have some drawbacks too. Okay. And I can only speak to my experience, right? A lot of times 401ks, especially if you want somebody else to administer them, can get expensive. Like the administration costs on the back end can get expensive. And a lot of times, depending on how big you are, you don't want to spend the $2,000 or $3,000 it may cost to set this thing up. And then it's going to cost you that every year. So a lot of times that's why we steer people towards SEP IRAs and or simple IRAs. And then that really comes down to a personal preference in how many people you may have. So in a SEP IRA, you can put up to 25% of your salary in there. Okay. But if you have multiple people and they're all under the SEP plan, if you want to personally put in 25% of your salary in, you then have to do that for your employees too. So there's less leeway because what you do for yourself, you have to do for your employees. Whereas the simple isn't set up that way, but you also can't put in near as much for yourself on a simple. And the IRS has rules against you having a SEP and your employees having a simple for that reason. So it's really, it's hard to say which one's best, but any of them are better than nothing.
Yeah.
Oh, amen to that.
You said something that was great, Goose, because it's kind of what we were talking about when it comes to behavioral finance. But a lot of time, I've seen this a lot on social media. Everyone, a lot of advisors are like, go solo 401k, go solo 401k versus a SEP. And technically, sometimes you can put more away with a solo 401k than maybe a SEP. But to your point, Goose, the solo 401k, even if it's only one participant, the owner, you still have to follow the 401k rules, and it's logistically takes more time to set up and there's an additional cost. And a SEP is just easy, so simple, to set up. And you still have the opportunity to put away a lot towards retirement and get that deduction if your net business income is high. Plus, with the SEP, you do have the option to make regular traditional IRA contributions into it. So you have your employer contributions, and then you can do a traditional IRA personal contribution all within one account. So it's very flexible, and it comes down to what the business owner wants. So again, Goose, to your point, there's nothing perfect, right? I mean, no plan is going to be perfect. The idea is, as planners, we're here to tell you what the plans available to you are and what we think might make the most sense for your business. But ultimately, it comes down to what the business owner's preference is, like ease and simplicity of a SEP, for example. I don't want to just sit here and, talk about SEPs all day, but to go on that example, the ease and simplicity of a SEP, or do you want to potentially put more away and you're okay with more work to do that? So maybe a solo 401k works for you,
Okay, I just want to clarify for the people who don't know. So 401k, where does the name for that come from?
So from my understanding, and Goose, correct me if I'm wrong, but that's actually just the number in the IRS code, section 401k. And then it lists out what hey, you can do salary deferrals, you can get up to this match, and it's a profit sharing plan, blah, blah, blah. But I believe it's actually the section within the code of why it's called 401k.
Okay.
Yeah, I would agree.
And a SEP is what? For the people who don't know, who are just getting into this, who are not going to understand the acronyms the way that we throw them around, can we take a couple steps back and make sure that we explain those well for people? Yeah,
I will say the SEP plan is deceiving because it stands for simplified. I may get this wrong. Employee pension plan. So it actually has pension in it, which normally throws people off because they're like, oh, it's a pension. Like, no, it's an IRA. So a lot of times SEP is easier not to confuse people. But that's what it actually stands for. And, I did study it and I do remember learning about it, but I have far put that out of my mind exactly why they decided to call it that.
I mean, I'm sure they had a reason.
Hey, there's always a reason. It's not always a good one, though.
No.
So we have a variety of different plans and things to choose from, depending on what you want and what type what type of business entity you have, probably these different things. Now, is the difference between an IRA and a 401k, is the difference generally how much you can put in one?
That's one of the bigger differences. I would say the biggest difference, though, between just a regular IRA, not Simple or SEP. Oh, and I thought this was a nice tidbit.
Okay.
Simple actually stands for Savings Incentive Match Plan for Employees. So Simple IRA, the reason it's called Simple, Savings Incentive Match Plan for Employees. But
Of course,
you know,
it
like
has to mean something. It can't just be simple.
No. In my opinion, they're not simple.
No.
I think a SEP is
No.
way more simple. But so a regular IRA, you know, that's just personal. 401k is a employer-sponsored plan. And, you know, a SEP would also be considered an employer-sponsored plan because it's for business owners, right? You have to have a business to set it up. Same with Simple IRA. Those are employer-sponsored plans, but they follow, technically they're IRAs, so they do follow some of the IRA rules, which, you know, if I'm jumping around here, I apologize, but as these thoughts come, I want to get them out. So like with the SEP, you have until the tax deadline, April 15th, to make your contribution. Same, you know, with a Simple, I believe. But you don't technically have that with a 401k. There's some nuances there where you can maybe get a contribution to a 401k in later than the end of the year, which is when you typically want them in, December 31st. You know, that's some of the main differences, I would say. You know, and then, yeah, you can get employer matches with 401ks. You can't really get an employer match with a SEP. You can with a Simple, you know, there's some kind of employer contribution there on top of the employee's deferral. But that's some of the simplest ways to differentiate between them. What do you think, Goose?
Yeah, I mean, I would agree. I mean, there's a lot of nuances in the difference. Their purpose is the same, right? I think as a business owner, if you've got a lot of employees, you've got a little bit more control within a 401k in terms of how you want to set up matching contributions. But if that's not important to you, then something like the Simple or the SEP, I think the Simple, you can match up to 3%. And you have to match that 2 or 3% whenever you set it up. SEP, you've got a lot of flexibility of whether you put into it or don't put into it each year. So each one, again, has different nuances about it. One thing I will say about a SEP is if you do have a SEP or want to do a SEP, you need a CPA. If you don't have one, don't try to do the calculation yourself on your max contribution. It's, you know, it's a circular calculation. And so unless you like those types of things, which most of us do not like circular calculations, find a CPA to do it for you.
Okay.
So,
Yeah.
Jeff has commented that he and his CPA set up a 401k LLC. I have never heard of that. Can one of you guys tell us what that means?
I'm going to say it's probably just like a 401k would be, except it's for the LLC, limited liability corporation would be my guess. It's probably no different than a regular 401k would, but I don't know that for certain.
I think in another comment, he said it's also known as the solo 401k. So I think we're just using different words.
Okay, I see that here. Yeah. Okay.
So Josh is being a troublemaker, Goose. I don't know if you saw his comment.
Josh is constantly a troublemaker, so that does not surprise me. Ask Megan Shapiro if he's a troublemaker.
So it hasn't come through on the Restream yet, Tammy, but I can see it on LinkedIn.
Okay.
And he said, let's talk about EBITDA and leveraging the company for sale, not just traditional concepts of saving. So, do either of you guys work with businesses who they're looking to have an exit strategy in their company?
So I don't work with a lot of business owners as far as exiting their business. But I do know, as far as in the financial advisor space, practices are being bought and sold a lot. So when he's talking about EBITDA, that's usually a way in our world to measure and get a multiple for the value of the business. So, okay, and these deals can be structured really a lot of different ways. So this, he wants to talk about EBITDA, and I'm assuming it's for selling a business, right? As a way to get money when you exit, and that's great, but that's like a lifelong process of building a business that's going to increase the multiple that you get. So, it really kind of depends. So like in the advisor world, what's your recurring revenue? What's the age of your clients? Are they all retirees, 70, 80-year-olds? Or do you have a book that's full of 30, 40, 50-year-olds that are in accumulation phase? That's going to change the value of your business, regardless of EBITDA. Doesn't really matter. If you have a great EBITDA, earnings before interest, taxes, depreciation, and amortization, that's great. But it really comes down to what a buyer is really wanting to pay for your business. You got to look at it from the buyer's perspective, at least in our world. And I think that's maybe true of any business, but a buyer is going to pay more for a book, in our case, a business that has, a great client base, that has, a good source of recurring revenue, that's clean. When it comes to financial advisors, how are you managing your money? A lot of advisors think, oh, well, I manage the money on my own and I can beat the S&P 500. Okay, that's great, but that's not, you can't replicate that if you sell your book, as much. If you're just picking and choosing every single investment within every single client account. So, maybe if you're using other third-party asset managers, it might be a little bit more replicable for a buyer. So, that's a way to do it, but it's also not guaranteed. I wouldn't not save in a retirement account trying to bank on, well, I've got good EBITDA and I'm going to exit the business and get a great multiple on my revenue and I'm going to be done. That's just, you definitely want to think about that, but you can't put all your eggs in that basket. At least that's how I would look at it. You'd
Too
still
many eggs in
want
one
to be safe.
basket.
Yeah.
And let's go back to the selling of a business, because you never know what it's going to sell for. You never know what a buyer's willing to pay for it. What's your growth rate? There's a lot of things that go into what your business is worth. What I will say for many people is they don't put enough forethought into how to exit, right? Because there's a lot more to exiting than selling your business. That is a piece of exiting a business. Think about, okay, you've been successful all your life. Do you really want to take that $10 million hit? Well, how are you going to structure a $10 million sell of your business? And I'm just throwing 10 million out there. That's a huge capital gains hit for many people, because many people started it on $1,000, $2,000, right? They've got the building, they've got real estate, they've got all these different facets of their business that they've grown over the last 30 years. There's a lot more to planning your exit than just selling it. And so many people make the mistake of, I'm just going to sell my business and get out. And they're giving a ton up to do that. There are ways to structure how you sell it, where some of that money goes, so that you can delay and or minimize the tax burden you're about to take. Because at the end of the day, you've gotten used to heavy cash flow. And this is another part that I don't think all business owners recognize. How you've gotten used to this heavy cash flow into your pocket. Now you've got no cash flow. how are you going to make the rest of this last? And most don't realize that it's not going to last near as long as they think it's going to, based off of what they're used to spending. So those are all things that people need to consider and get help at an early time to start planning it 5 or 10 years out. I mean, that's like selling your business is a 5 to 10 year process so that you have everything straight. It's not on a whim. I got an offer of $5 million. So there it goes.
Yeah.
But it's $5 million, Goose. Let's go.
Let's go. And you're gonna give up $1 million of it to the IRS off the top. So now you got 4, right?
My business, I will sell it today for $5 million.
Same.
And I will give the IRS $1 million.
Same. However, that's because we are not financial planners and have not been working for the last 5 to 10 years with the financial planner on an exit strategy.
Yeah.
Exactly. Because I mean, so you sell it for 5, you give up 1. What if you could sell it for 5 and give up 500?
Yeah.
Yep.
Right. Or the strategies to do that.
I think honestly, the whole topic of selling the business is really its own topic, honestly, because a business owner should be doing both. You should be planning for an exit strategy. It has its own assumptions, its own tax consequences, and it's just very up in the air. It's you can't plan on it like it's guaranteed, right? But you need to plan for as best you can how to make that happen and maximize your value there. But retirement contributions and saving there is its own animal. And you need to be doing both. You can't just, and I have seen and heard of business owners doing that. I don't need to save because I'm just going to sell my business and be done with it. Well, there's so many things that can make that not happen. I mean, even a legislative change could negatively impact your industry and drop the value. And drop the value
of it. Or worst case scenario, the bottom falls out and you have to declare bankruptcy or you close your doors. Then what? You can be left with nothing.
Yeah. So someone mentioned, that's why it's in the comments over here. That's why it's important to have balance in your assets. I kind of think Billy is mentioning or referring to like diversification of your assets, have different buckets of money that you can pull from. Yeah. Don't put all your eggs, even if it's your own business. That's the other thing. Don't put everything in your own business. Get the revenue in, diversify it out. So.
Okay. So one thing I haven't heard a lot about is Roth. So we talk about this magical unicorn a lot on the internet. And I think that people get kind of a false impression of what it is. So what is a Roth?
It's the best account ever. No, it's a good account.
I thought we weren't saying there's a best, Michael.
We weren't saying that.
I love the Roth IRA. I love Roth money. That's the way I look at it. There's Roth money because you can do Roth IRA, Roth 401k. I think they even made it like Roth SEPs available, but I love Roth money. So basically a Roth IRA, let's just back up a little bit. There's traditional and then there's Roth. So traditional, you put your contribution in and it's likely going to be tax deductible. Okay. So you get a tax deduction. Everything in the traditional IRA is going to grow tax deferred. Okay. And then whenever you pull the money out in retirement, it's taxed at ordinary income, the contribution and the earnings. That's key, in my opinion. Contribution and earnings. Now,
that's exciting. Okay.
Yeah, I don't know how that happened, but the Roth, you put your contribution in with after-tax money. You do not get a tax deduction.
I don't know if I'm back. Am I back?
You're back, man.
You're back. We see you.
With after-tax money. Then all the earnings, when you pull it out in retirement, whatever's in the account, it's just tax-free. So, obviously you've got to grow that money in your Roth IRA as much as possible, because the contributions are taxed, after tax money going in, but the earnings are all tax free. So, basically tax-free income in retirement or ordinary income tax at retirement, traditional versus Roth.
Okay, can I
Okay,
ask
Goose, you went sideways on us.
Sideways, man.
On our list, how does the money grow, Michael? So we say that, and I think everybody on the call knows the answer on our side. But what do you mean that the money has to grow?
Yeah, great question. Because I see this mistake from time to time where people put money in their Roth and that's it. You have to get the money invested. So when you put the contribution in, it's going in as cash and it sits there, and you want to get it invested, and ideally you want to get that invested aggressively. So in our world, when we say aggressively, we mean stocks, and you because you want earning growth. You don't want to have that money sit in cash. It's not going to grow at all. You don't want it to be in a bond portfolio. It's not going to grow at all. You want that money invested for growth so that you maximize the benefit of tax-free withdrawals on the earnings.
Goose, you are having so much trouble with technology. One more rotation.
You're still sideways. Do one more rotation. There
there
you
we
go.
Sorry.
Oh, we got
Hey!
him up there.
Technical
Hey, I told
difficulties. You gotta love it.
It's a fun show.
I
It's a
have no
fun show.
idea what happened, and
Yeah.
I have no idea what happened to my camera.
Funny.
But I'm back.
That's too-
Okay,
Okay, you're back.
so how do you know? This is one of our, Tammy and I always talk about vetting your professional. How do you know that you're working with the right professionals, guys?
Goose, you want to take that one?
Since I've been off screen and turned around and everything else, I'll take this one. So the first thing that I think you have to do is you have to have a connection, right? There's got to be connection both ways, because if you don't, you're never gonna feel comfortable enough really pouring out everything emotionally that's tied to your money, whether that's your business or your actual money. And we can't do our jobs to the best of our ability, and you'll never get the value out of us if you're not willing to do that. This kind of goes back to that original conversation that we had at the beginning, is this stuff is emotional, and we're all driven by different things. And those are the types of items that we need to know how to structure things, so that you do change behavior and you don't make a behavioral problem, which drives decreased return or whatever it may be, because something happens in the market. So that's the first thing. I would say you can look at credentials. I don't personally have any. I have no letters after my name. I do think that they are important, and that doesn't mean that I'm not going to get them. But I don't think that's a necessity if you have a great connection. We've all been through training. We've all had to get our securities licensing. So really getting down to that. And then the third thing is, are we being open with how we're paid, right? It's a sticky subject. Nobody wants to talk about it. A lot of people try to ignore it. I'm very upfront with how I'm paid and whatever I'm offering. Some people are fee only, some people are hybrid, some people are just commission. Understanding what that structure looks like, as well as why they've chosen that structure to be under, right? Mm-hmm. Because we all have those reasons. There's not a right or wrong reason, regardless of what anybody says, in my opinion, as long as there's reasons to back it up. Mm-hmm. So those are just a few things. I think the first one I named is the single most important thing, regardless of whether you're looking for a CPA or a financial advisor or your doctor. You have to have a connection so that you can be open about why you're doing what you're doing, so that we can really get down to the root cause and bring the most value that we can bring.
Yeah. I would mention, I sum it up on that first point you brought up, Goose. And I tell clients this or prospects this, it all comes down to trust. You have to trust me if you want to work with me. And you have to trust your accountant, your CPA, your EA, your attorney, your doctor, for sure. If you don't have trust, it doesn't matter how many letters behind your name you have. And so for me, that's the most important thing people need to think about when they're going to work with a financial planner, any professional, is you have to trust them. And how do you know if you can trust them? Well, you just have to have some discernment and have a meeting where you talk and get a feeling for the person. Is this person being honest? Is this person being genuine? Is this person kind of, BSing me, so to speak? And compensation. How do they get compensated? Are they comfortable talking about how they get compensated? And I think we in the advisor world, there's way too much put on fee only versus not. There's fee only advisors that, in my opinion, their compensation model is not very good. You could argue it's the equivalent of churning in the commission world. Charging a fee here, a fee there, and another fee over here. It can just be kind of a lot. And so, compensation, it's important to be open about it, transparent, but I wouldn't say it's a marketing point, right? Okay, you're fee only, big deal. You're a fiduciary. Okay, just saying you're a fiduciary doesn't make you one. You have to live it. Your actions are going to make you a fiduciary for your client. And it all comes back to the trust thing for me, and I've got to trust clients too, right? I'm sure as accountants, you got to trust people are giving you the right information, because you're signing off on, tax returns. So you have to trust that you're getting the right information. And so do, Goose and I, when we're doing financial planning, because for one, if we're not getting the right information, our plan is not going to be accurate. It's not going to be great. We're not going to do you any justice with false information in there. And then you really have to ask yourself, well, if this person is going to give me false information, do I really want to work with them, as a client? So, so that was a long answer, but yeah, Goose was spot on. Having a connection and trust that's the most important.
That's good.
Tammy, do you want to bring up the comment from Jeffrey about the digital world? I do think that Jeffrey's question is pretty good. What are your thoughts about the future with the digital world? Business models are changing, and what is anyone doing to support this future changeover? Finances are moving to the blockchain technology. Do we have any thoughts about that? Do you guys work with blockchain much?
Yeah, I'll give you my short answer. I'm not big on cryptocurrency or Bitcoin. I don't personally own any, because I'm also a big believer in, you need to invest in what you understand and what you know. And to me, and I'm sure I'll get blown up by the pro cryptocurrency folks, but to me, there's just there's no value behind it. What is it tied to? Like a cryptocurrency, digital currency. There's just like a fiat currency, right? It's not really tied to anything. But to me, when people are talking about Bitcoin, it's not the fact that they have 5 Bitcoins, for example, that's exciting. It's the fact that it can get you so many dollars. It's the exchange rate that they're excited about. I don't delve into it too much. I know some people are really big on it. I kind of tell clients like, hey, if you want to, again, let's diversify. If you want to have some money that you want to invest in, I don't really consider it an investment. There's an exchange rate there. You can make some money on it, sure, but it's not really an investment in my opinion. But if you want to put money into crypto and you are really into it and you understand it, I think that's great. But that doesn't negate the philosophy of, hey, let's diversify your assets across different types of assets, right? So we could have crypto, real estate, stocks, bonds, and then different types of accounts from a tax perspective to make those assets as tax efficient as possible. But Goose, any thoughts?
Yeah, I've got lots of them. But I don't have enough time to talk about all of them. I'm pretty much in agreement with Michael. I'm going to quote Charlie Munger here and say, I don't invest in things I don't understand. I understand that crypto moves based off of supply and demand, but what is that supply and demand of, right? Some technology I don't understand. So I'm not going to tell people not to put money into it if that's what they wish to do, because people that are crypto fans, they're going to be crypto fans and they're not going to listen to me anyways. I would urge them to have it as a small portion, and you never lost money taking profits. Okay. That is going to be my wisest thing I say all meeting long is you will not lose money taking profits. So if you happen to get in at the right time and it goes up, which it has a lot this year, why would you not at least take some of it off the table? If you believe it's going to continue to go up, great. Could also go back down to 20 where it was 2 years ago. So, it is diversified. I would say it is diversification. That might be where me and Michael disagree a little bit, because it is not tied to the market. It's somewhat like an alternative investment. You could look at it that way. But it is a very volatile one.
Yeah. Another way that I look at it, and I think this is investing in general, is like the whole idea of investing. You can boil it down to, it's about income, real estate, like the real estate investors, what do they like? They like the rental income, right? Either from residential or commercial. You've got that rental income coming in. Bonds, they pay interest income, taxable or tax-free. Stocks, yeah, they appreciate. They can also pay dividends, right? And so that's a form of income. And that's where, I look at, well, crypto, what does it pay? Nothing. It doesn't pay you anything until you sell something. And so you're going to have to be liquidating, and not really liquidating, you're exchanging your crypto for something else like the dollar, right? So you're going to have to exchange that and reduce your holdings in that currency to realize anything. Yeah. And you can make some money, like Goose said, but the way I look at it too, you don't want to make a living of liquidating your stock portfolio or selling your real estate portfolio in retirement, because eventually your income is just going to go down. You want to be able to find a way that you can live off of the income that your portfolio is generating. And that's not to say you're not going to have a year or two, where you may be selling some shares, but I don't think you want to make a retirement living off of selling assets. You want to accumulate assets that are going to generate income for you, because that's really, in my opinion, the holy grail of retirement, is like living off the income that your assets generate, because it doesn't matter what the price is doing then. Real estate I think this is the biggest difference between real estate and stock investors. Like real estate investors think the stock market's too risky because the price goes up and down every day. So does real estate. Technically, it goes up and down. They're just not looking at it. They're looking at the rental income. And if you can look at the income of your assets, then it doesn't matter day to day what the fluctuation in the price is as much.
Okay.
That's a really great point, Michael, that it is a lot the same. It is different, but it's a lot the same. And I'm going to throw this in Megan if she's still on. It's all about your risk tolerance, right? Like what amount of risk are you willing to take in either one? I personally do not really work with crypto clients. Also outside my level of expertise, it's not something I understand very well. And the amount of transactions for the little amount of money on some clients is just not always worth it. And so I have kind of veered away from that. But there are people who specialize in it. Yep. Megan said, yes, ma'am. Yeah. It's always about your risk tolerance level.
Yep.
So ultimately, where you invest is going to depend a lot on what you are willing to risk.
Mm-hmm.
We're going to run out of time. This is really informative, and we've covered a lot of topics that I didn't realize that we were going to get to. But that's good. That's what we like about our show, is that we start a conversation and we kind of see where it goes based on the topics that are brought up. So it's to me, it's really interesting. I'm going to throw another question, kind of in a different direction. So Amanda and I, we talk about this a lot. We talk about the plethora of horrible tax advice that there is out there on social media. So for you guys as investment people, financial advisors, what do you see on social media that makes you just
Cringe.
grit your teeth and cringe?
Man, that's a good question. I have to think. There's a lot. I mean, yeah. I mean, do you have anything, Goose, top of mind?
Okay, I have one. Hold on, I have one. Recently, I read that you should invest in car washes.
Oh yeah.
That one's the
So-
new one going around. Invest in car washes.
So I think so. I've got a lot to say. As normal, I always have a lot to say. So I will say there is a lot of good advice that is being put out there on social media, and there's equally as much bad advice. Okay. And it becomes very difficult for people to distinguish what is good advice and what is bad advice. That is the reason why professionals do what they do. Also, nobody on social media can tell you what you need to do because they don't know you.
Mm-hmm.
That is if there's one single value add that we bring, is it is customized advice to the client because we know you. Nobody can give you advice that they don't know you, because they don't know your risk tolerance. They don't know how much you're worth. They don't know how your assets are set up. They definitely can't give you tax advice because they don't know all those things.
Mm-hmm.
And so I think my biggest pet peeve about people on social media is when they try to tell you and convince everybody they can do it themselves, when
That's a good one.
there's so much value add that we can bring. It is not just about investments. And I think people need to get that out of their head. Yes, investments is a huge part of what we do. I happen to love investing, but it is a portion of what we do. And all the other things is what creates the value add that we have for you.
Mm-hmm.
So
Jimmy, he
I-
just
Good
like
answer.
made
There we
a
go.
new commercial.
Good
Goose, thanks
answer.
for the commercial. We're just
Yeah,
going to tailor that to
I'm
us.
done. I'm done. I'll get more heated if I keep going.
Can I say something that I see a lot?
Yes, please.
I've actually seen this from other CFPs, which blew my mind. It blew my mind because it's so false, and I think it was clickbait, or maybe not. Maybe it wasn't, but someone said, and actually not someone. A lot of people say dividends are bad because it's a forced liquidation out of your stock portfolio that you have to pay taxes on. And I'm just shaking my head because I'm like, dividends are not the same as a forced sale of your shares, because they were arguing, well, you could just sell shares and get the same outcome. And that's not true, because when you're selling shares, you have less shares that you own, which means your dividend payment next quarter is going to be less. If you keep selling shares, it is not the same outcome. Maybe if they're long-term capital gains and qualified dividends, the tax rate is the same, but it's not the same outcome. And the reason that a stock trades lower after what's called like the ex-dividend date is because you're getting you're buying the stock without the dividend payment that's coming. So of course it's worth less. So the price adjusts, but dividend growth and dividend payouts is what drives a lot of stock prices. So, some of these planners out there are saying, don't buy stocks that pay dividends. Now, I will say you don't want to chase dividends. Don't just look for stocks with the highest yield, but dividend yield, but don't just avoid dividend paying stocks, and we need to be, we just need to be more up. Some of these planners just need to be more upfront about what a dividend really is. It's not a bad thing. A dividend is not a bad thing at all. And the tax treatment is great. You can get dividend income taxed at 0%, depending on your income. I mean, who doesn't like that? And you don't have to do anything.
But that means you have to know your financial situation and be somewhat educated in all of those things, because and this is what I hate so much with social media propaganda, I think is the best word for it, is they give you little nuggets of half truths.
Yeah.
They give you things that you can hold on to, you can Google, that make it sound accurate, that are not accurate. And so Tammy and I often joke that Amanda is getting a yacht birthday party because I'm so opposed to that horrible tax advice for business owners. So it's a fun topic for us. And Tammy deducts all of her personal pets as security.
I do. My pets, they're dependents. So
I can pay my 7-month-old and get a deduction, right? And then fund her Roth IRA.
Okay, now wait a minute. I was going to say that's one of the ones that pops up all the time on our tax groups and stuff on Facebook is how do I hire my infant child and fund a Roth IRA in their name or something like that. And it's just like, it doesn't work that way.
Yeah.
Please slow down.
Maybe if they're modeling for a baby boutique.
Sometimes I feel like social media, it's like a flex contest. Like who can dump as much information that they think they know into a post and just see who knows the most. And it's just a little crazy because to Goose's point, you don't know anybody yet really as far as their financial situation goes. So you can't really give advice. I mean, you can regurgitate some stuff that you know, or unless you post about like, hey, this was a client situation I had, and this is how I navigated that. I like those posts. Those are great because they're real.
Okay, hold on. But I need you to, at the bottom of it, put how many of your clients that would actually be applicable to.
Yeah.
Is it the 1% or is it the 99%?
Well, but I will say, so Michael had one recently, and it was a great example.
My UTMA 529 one?
Yeah, I read it. But I think what it shows, it shows from what he did was, hey, I got down to the root of what my client was looking to do, and I found a way to do it more effectively, and that's going to pay so many more dividends than just this blanket advice, right? Yeah. I mean, that when I read that is what that told me. Yes, the technical aspects of what he recommended and suggested were great. It was a great technical post, but I took out of it way more about him getting down to what this client needed and wanted and a more effective way to do it.
Yeah. And then with that particular client situation, she, had a specific goal where there was another account that made more sense for that goal. But then how do you unwind it, basically? How do you get to that? And that's where I really had to kind of stop and think, because I was like, okay, if we just go for it all in one shot, move one account to the other, big tax consequence for the child, because these are minor accounts, and I didn't, then they'd have unearned income and maybe have to file a tax return and just a mess. And so it was, okay, well, let's take it in steps, to focus on minimizing any kind of annoying tax thing you have to do or paying any taxes in general.
You mean like actually planning?
Yes. Yes.
Okay.
And make it specific to the client. So to answer your other question, Amanda, this post was, the disclaimer would have been, this was just for this one client. But if you have any other clients that have this exact situation, you might be able to do this.
Yes.
Yeah.
Well, okay. So I'm talking in the tax world, buy a building, do cost seg, and you're going to $400,000 in deductions the first year. And you're like, no,
Nope.
that applies to like one person.
Yeah.
No.
Don't take that. So anyway, I'm
Okay.
just always curious percentage that it would be applicable to. That would be my request. If you're going to post those, I need to know how many of your clients would actually apply to.
Yeah.
Yeah.
That's good.
Well, guys, we've run 5 minutes over, so I think we're going to wrap this up.
But thank you.
Cool.
Yeah, I'm so
We
glad
had
y'all
fun.
came here.
I had fun.
Liked it.
I want to give y'all a chance to tell people how to reach out to you before we go, because there is still time between now and April 15th to set up a retirement account if you don't have one,
Mm-hmm.
or to make a
That's right.
contribution if you do have one, right?
That's correct.
Okay.
April 15th, tax deadline. That is the beauty of IRAs instead of 401ks.
Yeah.
For an IRA.
Just
For an IRA.
Yeah.
Yeah.
One of
I mean,
the pros.
one of the many. SEP doesn't matter. SEP, simple, regular, doesn't matter. But since I'm talking again, I'll go ahead and go. Follow me on LinkedIn, John Goose Dunham. If you want to email me, john.dunham@lfg.com. I like to post. My posts are not very technical. I normally post about my experience in the financial world as well as the manufacturing world, and blend the two together, and really try to relate to a lot of blue collar type industry people, whether that's managers in those industries or whether they're the actual blue collar workers themselves. I think simplifying finance is so important for people to want to make the next step. So I really focus on that versus the technical aspects of what I do every day.
Yeah. And I'd just say easiest way to find me is going to be LinkedIn as well. On there, it has my email. It's pretty long, michael.j.didion@didionwealthmanagement.com. Funny thing about that, when I was setting that up,
again?
the tech guy was like, you want to shorten that up a bit? And I was like, no, it's fine. And then now I'm realizing, wow, this is so long. Like, it doesn't even fit in like some like email spaces on websites when you're trying to put that contact info in. But it's got my office and website in there, so you can reach out to me there, or message me on LinkedIn if you have any questions, or just want to chat about your situation. Be more than happy to. But that's the easiest way on LinkedIn. And I just love helping individuals, families, and business owners, again, get in a position to bless their families and bless others, and really help them with life's most important financial decisions. So
Good deal. And if you're out there and you can't figure out how to get in touch with them, which I've put the links up, you can always ask me and Amanda.
Yes.
So we'll get you to one of these guys. It's been great having y'all. I think that we will probably reach out and have you on again to talk more.
awesome.
Because there's probably a whole lot more that we need to cover. So, and you're both really fun guys. So I think you'll get an invitation to the yacht birthday party.
Yes.
Oh yes, that's the only reason I came on, was because I wanted an invitation to the yacht birthday party
We know.
and the tax
grand.
deduction, right?
And it's a tax deduction. It's going to be. Maybe we'll broadcast from the yacht, and then would that make it deductible, Amanda?
And then
I mean,
everybody can
definitely.
just say it's a conference or something. We'll figure it out.
It's definitely
figure it out.
necessary and ordinary, right? For your
very,
business.
very, Michael.
It's necessary and ordinary. You are absolutely correct. It is. All right. Thanks for coming, guys. Thanks
for having us.
everybody. Yeah, we'll see you in 2
2 weeks
from today with another exciting episode full of really good information. Hope you enjoyed. See
Thanks,
ya.
y'all.